If you have been following this series, you now have a reasonable good understanding of what a structured note is, how it's built, how the bank makes money from it, and how to evaluate whether the issuer is safe enough to trust with your capital. But at some point, you have to ask the obvious question: how does this compare to a bond? How does it compare to a fixed deposit? And is the added complexity actually worth it? That is exactly what this video is about. We are going to pull all the three instruments on the table: fixed deposit, bonds, structured notes, and we are going to look at them: returns, risk, liquidity, capital protection, complexity, everything. This is not a competition. I am not here to tell you that one is better than the other. Each instrument exists for a reason. The question is always which one is right for you and why. Let's start with the one most of you already know: the fixed deposit. Most of you have had one at some point. Some of you have a large portion of your savings sitting in one right now. And I understand why. It is simple. You give the bank your money, the bank gives you fixed return. At the end of the term, you get your money back. No surprises, no complexity, no need to monitor anytime. In the UAE, a typical fixed deposit today will give you somewhere between 2 and 4% per year, depending on the bank, depending on the tenure, depending on the amount. And on paper, that sounds reasonable. But let's think about what that actually means in practice. If inflation is running at 3% and your fixed deposit is giving you 3%, your real return is zero. You have not grown your wealth. You have stood still. And in some years, if inflation is higher than your deposit rate, you're actually going backward. That is the first thing to understand about fixed deposit. They are not a wealth building tool, they are a capital preservation tool. Most people confuse the two, and that confusion is expensive. Now, the second thing, safety. The large banks in the UAE are well regulated and well capitalized. The UAE government has consistently shown that it stands behind its financial system. But even so, it is worth understanding what you are actually doing when you place a fixed deposit. You are lending money to a bank, and like any lending, it carries the credit risk of the institution you are lending to. Most people do not think of it that way. And the third thing, liquidity. If you need your money before the deposit matures, you will pay a penalty. In most cases, you lose a portion of the interest you have earned, sometimes all of it, so that capital is not as accessible as it appears. So this is what a fixed deposit actually gives you: low return, return close to zero after inflation, capital protection that depends on the bank's strength, and limited access to your money until the deposit matures. For short-term goals, for emergency reserves, for money you generally do not need to touch, fixed deposit makes sense. But if you are trying to grow wealth over 3, 5, 7 years, a fixed deposit alone will not get you there. Now let's move to bonds. Most people have heard the word, so let's start from the beginning. When a government or a company needs to raise money, one of the ways they do is by issuing bond. What they are essentially doing is borrowing from investors. You give them your capital, they promise to pay you a fixed coupon, a fixed interest payment at regular intervals, and at the end of the term, they return your principal. It is not very different from a fixed deposit in that sense. The structure is similar. You lend, they pay, you get your money back at the end. But here is where bonds are different. With a fixed deposit, your money sits with the bank until maturity. You cannot sell it. With a bond, you can sell it before maturity. There is a secondary market, but the price you get depends on what is happening in the market at that point of time. The price of a bond in the secondary market moves. It is not fixed, and the biggest driver of that price movement is interest rate. For argument's sake, say you bought a bond paying 6% per year, then interest rate in the market go up. Now new bonds are being issued at 7%. Your bond is still paying 6%. So if you want to sell your bond before maturity, nobody is going to pay you full price for it. Why would they buy your 6% bond when they can get a new bond at 7%? They will only buy it at a discount. This is called duration risk, and it is a very real risk, particularly in an environment where interest rates have been moving. If you hold the bond all the way to maturity and the issuer does not default, you get your full principal back. But if you need to exit early, the price you get depends on what the market is doing at that moment. Now, the other risk with bonds is credit risk. This is the same we discussed with fixed deposit. The risk that the issuer cannot meet its obligation. Government bonds are generally considered low risk. The assumption is that a government can always raise taxes or print money to meet its obligation. Corporate bonds carry more risk. The higher the coupon a corporate bond is offering, the more risk you are usually being asked to take. That higher yield is compensation for that risk. So with bonds, there are two risks that do not exist with a fixed deposit. Interest rate movement if you exit early, and credit risk that varies depending on who issued the bond. Bonds are a legitimate instrument for income-focused investors who understand these dynamics and are comfortable holding till maturity. They make a lot of sense. But they are not as simple as they are often presented. Now let us bring in structured notes, and this is where the comparison gets interesting. Now, if you have been following this series from the beginning, you already have a good understanding of what a structured note is. But in the context of this comparison, I want you to revisit it, because sitting in next to a fixed deposit and a bond making certain things much clearer. Let me start with something from my own experience. When I was working at a private Swiss bank in Geneva, the structured notes were not a niche product. They were not something we offered occasionally. They were central to how we manage wealth for our clients. Every portfolio had them in some form, and the reason is simple. A fixed deposit gives you one outcome, a bond gives you one outcome, a structured note gives you something different. It gives you a designed outcome. You decide what you want and the bank engineers it for you. If you rip apart a structured note, what you find underneath is a bond plus a derivative. The bond component is what protects your capital. The derivative component is what gives you the potential for higher returns. We covered this in detail in video 2. But the key point here is this: that structure is what allows a structured note to do things that a fixed deposit and a bond simply cannot do. For argument's sake, say you want exposure to the S&P 500, but you want a level of protection built in. A structured note can be built to give you participation in the upside of S&P 500 with a barrier of 70%. Meaning, as long as the market does not fall by more than 30% from where it started, your capital is protected. You get the upside and you have a buffer on the downside. Or say you want 10% income per year, but you want some level of protection built in. Again, a fixed deposit will not get you a 10%. A bond at 10% would carry significant credit risk, but a structured note can be engineered to target that return with defined conditions attached to it. This is what I mean when I say a structured note is like a blank sheet of paper. You tell me what you want, the bank creates it. But structured notes are not for everyone, and there are some things you need to understand before you go in. The first thing is simplicity. A fixed deposit you can explain in one sentence. A bond you can explain in two. A structured note requires you to understand the term sheet, the barrier levels, the observation dates, the auto call conditions, the payoff structure. If you do not understand these things, you should not be in the product. The second thing is liquidity, and I want to be clear about this. Almost all structured notes today come with a guaranteed buyback from the issuing bank. So you can always sell before maturity. That option is there, but the price you get is the market price at that point in time. and the market price may be lower than what you paid. So the risk is not that you are stuck. The risk is that if you exit at the wrong time, you may book a loss. And the third thing, and we covered this in video 4, is counterparty risk. Just like a fixed deposit and a bond, a structured note is ultimately a promise from the issuing bank. If the bank fails, you are an unsecured creditor. This is why issuer selection matters. This is why we diversify across issuers. So structured notes sit in as an interesting place. They offer more than a fixed deposit and more than a bond in terms of what they can deliver. But they are not simple. You need to understand what you are getting into, and you need to read the term sheet. And who are they suited for? Investors who have a clear objective, who understand what they are buying, and who are working with an independent advisor, someone who can look across the market and find the right structure for them, not just the one that is available. Now let's put all three side by side. You can see the comparison on the screen. Let me walk you through the key points quickly. Who issues it? Fixed deposit, a bank. Bond, a government or a company. Structured note, a bank. In 2 out of 3 cases, you are relying on a bank. Issuer strength matters across all 3. Capital protection, fixed deposit, yes, as long as the bank survives. Bond, yes, if you hold to maturity and there is no default. Structured note depends on the structure, conditional in most cases. Always check the term sheet. Returns, fixed deposit 2 to 4%, bond 3 to 6%. Structured note depends on how much your risk you are taking depending on the conditions. Higher returns always means something is attached to it. Liquidity, in fixed deposit, it's locked in. Penalty to exit early. Bond, secondary market exists, but price depends on interest rate. Structured note, guaranteed buyback from the issuer, but you sell at market price. Customization, in fixed deposit and bond, none. You take what is available. Structured note, fully customizable. That is the core difference. Complexity, fixed deposit, simple. Bond, simple to moderate. Structured note, moderate to high. The more tailored the product, the more you need to understand it. That is the full picture. Now let us talk about when each of actually makes sense. So when does each one actually make sense? Let me give you a simple framework. A fixed deposit makes sense when your priority is simplicity and you do not need the money to grow significantly. Emergency reserves, short-term goals, money you generally cannot afford to put at any risk. For that purpose, a fixed deposit is perfectly fine. A bond makes sense when you want a predictable income stream and you are comfortable holding to maturity. You understand credit risk, you have done your homework on the issuer, and you are not going to need to exit early. In that situation, bonds are a legitimate and time-tested instrument. A structured note makes sense when you have a specific outcome in mind. You want more than what a fixed deposit offers. You want some form of protection that a direct market investment does not give you, and you are willing to understand the structure before you commit. Let me give you a simple example. Say you have $500,000 sitting in a fixed deposit earning 3% per year. You're not comfortable putting it directly into the stock market, but you also know that 3% is not going to get you where you want to go. A structured note can sit in between. It can give you market participation with a defined level of protection. It is not a miracle product, but it fills a gap that a fixed deposit and a bond cannot fill. The question is never which instrument is the best. The question is always, what are you trying to achieve? What level of risk are you comfortable with? And which instrument is built for exactly that? And that is what this series is really about. Not telling you what to buy, but giving you the tools to ask the right questions. One final important note, everything we have discussed today is for educational purpose only. I'm sharing my experience from the banking world to help you understand these tools. But this is not financial advice. Markets involve risk and structured notes are complex. Always speak with a qualified advisor and read the specific term sheet before putting your capital at risk. So this is how the three instruments actually compare. Fixed deposit for simplicity and capital preservation, bonds for predictable income with some credit and duration risk attached, and structure notes for investors who want a designed outcome with the right structure, the right issuer, and the right advisor by their side. None of these is the right answer for everyone, and none of them is the wrong answer either. It depends entirely on where you are, what you need, and what you understand. In the next video, we are going to look at another comparison that I get asked about a lot, particularly here in Dubai. Structure notes versus real estate. Two very different instruments, but for many investors in this part of the world, they are competing for the same capital. So that is worth going through properly. I will see you in the next one.